Welcome everyone to this event on VAT and the Northern Ireland Protocol. This session was originally recorded back on the 8th of October, but since then HMRC have provided further clarity in terms of the VAT treatment of certain movements, and as such we have updated this chapter in this session. A bit of an introduction then. For those who don't know me, my name is Michael McNeil. I'm a Senior Manager in the Indirect Tax Department in PwC Belfast, and I've been assisting Invest Northern Ireland now ever since the Brexit vote, following the different twists and turns to where we are today in regards to the Northern Ireland Protocol. So on screen now, you will see a bit of a Brexit timeline, and at the original point of recording, we were hoping for the 15th and 16th of October to provide us with further clarity in terms of any trade deal. Since then, it looks as though there will be no trade deal, but irrespective of that, the Northern Ireland Protocol is somewhat set in stone, notwithstanding, of course, the Internal Markets Bill. And so the Northern Ireland Protocol forms the basis on which we will trade with the rest of the UK and the EU and further afield come 1st of January 2021. So with that in mind, we thought it would be useful then to break down each of the trade flows, both in terms of north-south, east-west, to help you better understand the potential impacts for VAT purposes, therefore. Before we get started into the detail, I suppose it is worth bearing in mind that whilst HMRC have most recently provided further clarity in terms of VAT, and that's a most welcome note, and certainly it does simplify things for us here in Northern Ireland, there remains some unknowns for which we continue to seek clarity from HMRC. So the focus of today is, of course, VAT. I would say that although it is the focus of today, I will mention customs at some points, and that is inevitable given the close relationship between both taxes. So please bear that in mind. So on the first scenario, in terms of movement of goods between Northern Ireland and GB, it is key to bear in mind when we talk about VAT consequences of movements. VAT consequences are a result of physical flow of goods. It is somewhat irrelevant where the parties in terms of that transaction are established. We follow the physical flow of goods for VAT purposes. So what does the Northern Ireland Protocol say about VAT? Well, it says that Northern Ireland will follow EU VAT rules on goods. And up to this point in time, this has caused a lot of confusion locally in terms of what this means for local business and the flows of goods and VAT. So most recently, HMRC have provided further clarity on this. There has been a lot of noise in regards to the European side saying that Northern Ireland business will be issued with a separate VAT identification number. HMRC have since clarified that point and said that the VAT return will remain as is. It will remain with the 9 boxes as currently provided for. Within that HMRC guidance, it provides that sales between Northern Ireland and GB will continue as normal unless they're entering a special customs procedure, such as customs warehousing, for example, are subject to a domestic reverse charge. And that domestic reverse charge is only relevant for certain supplies, for example, of electronic chips, or indeed next year there will be a domestic reverse charge for the construction industry. So whilst technically speaking that relationship between Northern Ireland and GB is an export and import for VAT purposes, in HMRC's publication, they're relying upon an EU directive to simplify measures to allow for the collection of this VAT, which is essentially import VAT. So as it stands then, for sales, day-to-day practicalities, there's no change for VAT purposes. You continue to charge that UK VAT as normal, subject to the relevant rate. And of course, those in the agri-food sector will be well aware of the zero rating, etc., of their goods. On the movement of goods between Northern Ireland and GB, where you retain that legal title to those goods and you're simply moving, say, stocks of goods into GB to be closer to those those customers, for example, for them to call off as required. HMRC say that no VAT should be accounted for on those movements, and we'll see the difference here in terms of the flip movement from GB into Northern Ireland further on in the presentation today. It's also been clarified that no Intrastat returns will be required to affect these movements, even though Northern Ireland will be an EU jurisdiction for VAT purposes. There will be no Intrastats required on those movements. An interesting one is further clarity in terms of VAT groups. So HMRC have said that there'll be no VAT charge if the goods are located in Northern Ireland and the transaction is between two members who are Northern Ireland established. However, where one or both members only have establishments in GB, VAT must be accounted for on that transaction between VAT group members, which are ordinarily disregarded for VAT purposes. Finally, then, the latest position in terms of those movements is that the UK government has stated that there'll be no additional paperwork, no additional checks, and no additional customs duty payable on those movements, which does help simplify those movements and sales into GB then. Moving on to the flip side of things in terms of the movements between GB and Northern Ireland. Again, whilst this is technically an import into Northern Ireland, and import VAT is due, HMRC have said that will continue as normal. So the charging of VAT by your supplier should continue as normal, as it does now. They should issue you with a VAT invoice. You use that VAT invoice to recover that VAT as normal. Again, unless those goods are entering a special customs procedure subject to the domestic reverse charge. So for all intents and purposes, there's no change there on any purchases of goods that you bring in from GB. There is a difference, however, in terms of the movement of own goods. So in the movement of own goods from GB into Northern Ireland, VAT must be accounted for on those movements. So effectively, you'll be charging yourself VAT on your UK VAT return. And if you're fully taxable, you should be able to recover that simultaneously in the VAT return. So for our purposes, it's simply a VAT accounting entry where you're fully taxable. It's a nil net effect, but there is that requirement to show that deemed supply effectively in your UK VAT return on the movement of your own goods from GB into Northern Ireland. So for example, if you do have own stocks of goods in GB and you're moving those for sale into Northern Ireland, there'll be that requirement. Similarly, where there's a VAT group in place and there is this movement between GB and NI, like the movement of own goods, you'll be required to account for that VAT. Again, if indeed you are a fully taxable VAT group in this instance, then that VAT is recoverable in the same VAT return. So a VAT accounting entry only. So businesses should indeed consider whether systems are correctly or can be amended, to take account of these changes if indeed you are in this space. Again, even though Northern Ireland will be a EU jurisdiction for VAT purposes, no Intrastat returns will be required. That has been confirmed. And the biggest point in terms of these movements is the at-risk test for customs duty purposes. So where the goods are coming in from GB into Northern Ireland and they're ultimately deemed at risk, therefore there's a potential that you could indeed incur EU tariffs on those movements. Where indeed those EU tariffs are incurred because your goods are at risk and the goods remain in the UK market, there should be a mechanism to recover that customs duty payable. And that is all dealt with, and that should all be dealt with by the Trader Support Service in terms of the documentation around that. If we do get a deal, then those EU customs that would be payable should be reduced to nil. But I would just stress that on these movements, full customs declarations are required, so that there may be additional delays in that space. But the main action for businesses here is signing up to the Trader Support Service and being aware of that service, because the UK government will cover the costs of that. So that's a welcome note. So please do sign up to that Trader Support Service if you haven't already done so.